Hi, everyone. Thanks again for tuning in to another episode of Our 2 Cents on Your Dollars. I'm James Enriquez.
I'm James Credo.
And I'm Leo Chang.
And it is the most wonderful time of the year.
Riveting.
That's right. Taxes. That's the most wonderful time of the year. Or is it? We don't know when we're actually filming this.
Oh, could be.
But yeah, taxes.
What about them?
You tell me.
Woo. Terrible.
I mean, it's a big topic for us for sure. I think one of the biggest reasons, and for me actually joining the group a couple years ago, was this guy's love for the tax industry, and he got his EA and that designation, and one of the things that for me that helps propel our practice and elevate it in retrospect to some other practices is the influence of how taxes are influenced in the way that it affects clients' lives, decision making, the financial planning decisions that we have as well too. And so we get a lot of questions around it. We have some really good solid foundational relationships with CPAs as well too, and the communication discussions that we have and what they hear from clients as well too. There's a lot of things that are misconstrued. There's a lot of things that that we'd like to address and provide a little bit of foundational understanding and knowledge. So hopefully clients, other advisors, people watching can get a little bit something out of this discussion.
Yeah. So let's do that. Let's talk about why we're even talking about taxes. Let's give some tax tutorials. Yeah. And let's talk about some common misconceptions. So why are we talking about taxes?
For one, everyone has to deal with them. We live in America. We have the pleasure of living in a state that has no state income tax, but we deal with other tax circumstances and situations. And so taxes have a huge influence, I believe, in a lot of the financial planning decisions that clients make. And so a lot of the advice we provide, a lot of the planning strategies revolve around some really important tax strategies that affect clients. So it becomes a big conversation. It affects investment decisions that we make and provide. And so those are things that affect every client and, are top of mind a lot of the time.
Yeah. All right. So just for clarification, when we say taxes, we're talking about federal income taxes. And I usually like to tell people what I tell people is I can't tell you what your return is going to be. I have no idea, but I can definitively tell you if you do X, this is the Y tax impact.
Yeah.
And so I think it's an easier way to quantify those things. And of course, y'all have heard me say on other podcasts, one of the biggest reasons why I talk about taxes is because, as Leo said, a lot of the strategies we implement have a tax impact, and most clients ask, how is this going to impact my taxes? So figured we just go ahead and talk about it.
Yeah, lots of opportunity on the planning side too. And we believe in tax efficient returns. And then also there's a lot of moving parts and it's always changing. And yeah, clients have a lot of questions on it. So
yeah. Okay. So what's the biggest question / misconception that you hear from clients?
One of the things I hear is the difference between deductions and credits. I think they kind of confuse one for the other and vice versa. But a deduction reduces your taxable income, and a credit reduces your tax liability dollar for dollar. But sometimes clients feel like they're kind of both the same thing. And so I hear that question a lot especially during tax season.
Yeah. Can you give us an example of that? What you mean?
Yeah. For example, tax deduction would be something like your contribution into your 401k. You make that contribution, it reduces your taxable income, which potentially can reduce your tax liability. A tax credit is something that will reduce. If you owe taxes, it'll reduce it dollar for dollar. For example, the child tax credit, if you qualify, and it'll reduce your tax liability up to $2,000. So
okay, yeah. Just to help put some numbers around it. So let's say you make $100,000, you put $7,000 into a traditional IRA and it's a tax deduction, you will pay taxes on $93,000, meaning the tax savings is whatever marginal tax bracket you're in times that $7,000 tax deduction. Whereas if it was a $7,000 tax credit, you're going to reduce your tax burden by $7,000. So, James mentioned about if you qualify for that tax credit, what are some ways you qualify for deductions or credits?
Well, one of the circumstances that they look at is how much income you make, right? So, for example, there are income limitations to contribute to Roth IRAs. So currently, right now, we're in 2025. If you file single, your income limit is $165,000. So that means if you make more than $165,000, you file single, you cannot make direct Roth contributions. If you file jointly, I believe that income limit is 240.
The phase out starts at 236.
236. Yep, 236, and phases out, and then completely phases out at like 240, 245-ish. But if you make, as filing jointly, you make above that dollar amount, you can't make direct Roth contributions. So income is a big proponent to whether you are eligible to do certain contributions, certain deductions, things like that. There are so if your employer provides an employer-sponsored plan, you can't do, if you're not contributing in that employer-sponsored plan and participating in that employer-sponsored plan, you can't do traditional IRA contributions and utilize that deduction. There are different things that affect whether you can do certain deductions or not, as well as credits too. Same thing. Income is a big proponent of that.
Now, when you say income, do you mean like, hey, I got $100,000 salary, so I'm good?
So no. So it's adjusted gross income. So it is your income after you make all your adjustments. So everything that you deduct above the line, which is your adjusted gross income line, that number determines your eligibility.
Okay. But just your salary, just your employment income?
I mean, any income.
Yeah, income from interest, dividends, all of that will, capital gains.
Yeah, anything.
Yeah. Mm-hmm. Yeah, I think what's interesting too is the term modified adjusted gross income is defined based on the deduction or credit you're trying to qualify for.
Yes, that's interesting, right? Yeah, because so there are certain rules regarding certain eligibilities, and the way they determine that eligibility is different, right? So when it comes to Medicare premiums, the way they calculate your cost, your eligibility in regards to Medicare premiums is different than the way they would calculate eligibility for other things, for Roth contributions, for anything different. So the calculations tend to be different depending on what you're trying to qualify for, and it's good to know how they calculate that.
Yeah, it's so weird. MAGI usually means you're adding back something to your AGI.
Right.
So Leo mentioned for Medicare premiums, you start with your AGI, and then you add back your tax exempt interest. But for Roth IRA eligibility, you're starting with your AGI, but you're adding things back like your IRA contribution and income you've received from doing a Roth conversion. So I don't know who thought of these things, but
yeah,
you have to be.
Loser.
So even though it's MAGI, you still have to look in terms of which credit you're trying to take advantage of, or what strategy you're trying to take advantage of. Look at how they define MAGI to qualify for that strategy or credit.
Yeah. I think it'd also be worth noting that depending on when this episode drops, we just talked about the 2025 income limit. Mm-hmm. When this episode drops, you still might be able to make a 2024 Roth IRA contribution because you have up until the tax filing deadline, the 2024 tax filing deadline. not including extensions.
Right.
And so that income number is different for 2024. So every single year
Changes.
that right. So it's important to be aware of those things. Yeah.
One of the things we just brought up is above the line, below the line. So it's a term used in fancy tax talk. So it what that means. So the line, what that identifies as, is your adjusted gross income line. So there are certain things that you would deduct to get to your adjusted gross income, and then there are certain things that you would deduct to get to your taxable income. So a couple of things that are above the line would be HSA contributions. I think student loan interest debt is one that is above the line. Below the line would be like mortgage interest payments. There's multiple different things you can look through, but the difference between what the line is, your adjusted gross income, then there's certain things that you would deduct to get to your AGI, and there's certain things that you would deduct then to get to your taxable income.
Okay, so let me get this straight. So if some of these deductions depend on my AGI and some of these deductions are above the line, would it be worth trying to reduce your AGI so you can qualify for these deductions?
Yeah.
Okay. How do you do that?
Well, a simple way is, because most people have access to a employer retirement plan, is making sure you take advantage. If you have a 401k, that is an above the line deduction, which will reduce your AGI, which will help you qualify for other benefits and credits. So, yeah. And Leo mentioned, I think the HSA too is another strategy that can do that.
Okay. All right. Now, generally speaking, which one's better? We're talking about deductions and credits. So generally speaking, which one's better, a deduction or a credit?
Yeah, credit is you're getting literally reducing your tax dollar for dollar. So
Is that good?
yeah, I mean, I love Panable Sam. What are you talking about?
Oh, you're
I know
good
exactly
patriots.
where that dollar goes every single time it gets sent to the government. So I get super excited about it.
You are a good American, sir. Thank
Patriot,
you. Thank
they would
you.
say.
Yeah, yes. I salute you.
Yeah, so I mean, James mentioned the child tax credit, $2,000. That is, if you owe $5,000, you get your child tax credit. You now only owe $3,000. So that's more beneficial than just lowering your taxable income by $2,000.
I got a question for you guys that I
Oh,
didn't prepare
boy.
y'all for. Yeah, you know, because I didn't prepare you guys for
Here we
this
go.
one. So I'm and it just left me.
Good.
Yeah, you guys lucked out.
Thank you.
Actually, and it
It
came
come
back
back.
to me. You're out of luck.
And it's back.
Okay.
He does love taxes.
Do you ever? Will you ever tell a person, like, if a person's not anywhere near the ability to lower their AGI enough to qualify for a deduction or a credit, where you just kind of throw up your hand and say, there's not much you can do. You should probably just forego that tax deduction. Give me an example. Yeah. Okay. You just mentioned you can add to your employer-sponsored retirement plan to reduce your AGI, and maybe because you're trying to qualify for something. Because by the way, AGI also impacts your student aid.
Yeah, financial aid. Yeah.
Yeah, financial aid.
Yep.
So if there's no amount of money, or you can't put, due to limits in your 401k, you can't put enough into it to reduce your AGI low enough to qualify for certain things, what do your clients typically do? Do they say, well, I'm not going to put in that retirement plan because it doesn't really matter? Or what do you recommend?
No, I mean, it's case by case, but for clients planning for retirement, whether or not you're able to reduce your AGI enough for credits in a financial planning relationship, you're still trying to reach a retirement objective. So that's why you always have to look at it holistically, the impacts of all these decisions. Yeah.
Yeah, I mean, I'm going to try to in that process, I'm going to try to utilize the most tax efficient way, right? So I'm going to make a recommendation that is, one, helping them get to that goal, And if there is an opportunity that allows them to be more tax efficient, then I'm going to make that recommendation. Whether it's going to help them become eligible for a credit or not, I'm still going to make that recommendation.
You guys are crazy. You're talking crazy. So you're telling me to not let the tax tail wag the dog? Is that what you're essentially saying?
That is.
Okay. So you're telling me it might not be a good idea to buy that luxury SUV that I don't need.
Is it EV?
Is it?
I don't know. Well,
How much does it weigh?
well, yeah. Why do you ask, sir? Why are you asking?
This
sir?
is from experience.
So, yeah. So let's talk about that, right? I mean, come on. It's
Sure.
y'all get. I'm sure you've gotten that, right?
Sure, of course.
Right.
Of course.
I just had it happen.
Well, by golly, just yesterday.
Yeah. Let me tell you, sir.
So.
Okay, yeah. So for those of you who don't know, right, a lot of people will want to buy a vehicle, usually typically at the end of the year, so they get a tax deduction. Might not necessarily need it,
Right.
but they want the tax deduction.
Right.
What do y'all typically say to that?
I mean, it's crazy sometimes because you're like incurring a large expense for a deduction that you might not actually need, and that's what you're doing because you're so tax planning. And yes, reducing taxes is part of financial planning, but sometimes you're just going way overboard that you're spending so much money just to get a deduction, and the math doesn't actually quite work out.
Math don't math.
Yeah. Yeah. And then you're increasing your likelihood for probably an audit if you're too aggressive.
Yeah.
Yeah.
Yeah,
So-
especially I know some clients get recommendations and they do it frequently.
And some of our retired clients will sometimes mention, if someone had just mentioned to me that I didn't really need any more deductions, and someone had mentioned that if I did a Roth IRA, I would rather have forgone the additional deductions, knowing that in the future my retirement portfolio would all be tax free. I may have considered it. So easier to say in the future, but
Right.
that's what they say.
Yeah. Well, the thing too is we're in such a favorable tax environment currently, right? So making deferred decisions right now, excessive deferred decisions right now, that over time, and we don't know, it's tough to predict what the tax environment's going to look like in the future, but making over deferred decisions right now where more than likely, and from a probability aspect, we're in a really favorable situation currently, paying the tax might not be the worst thing to do, right?
Yeah, it is favorable, but I think some people look at their highest marginal rate versus their effective rate, which is
Hey.
actually the dollar amount they're paying. And so I think sometimes people think that highest marginal rate is what they pay for all of their income. So
Unpack that, sir.
Leo's better explaining it.
No, yeah. So
Yeah.
it is funny because I actually went through this yesterday with a retiree, and they didn't realize that how our marginal and progressive tax system works. And so, yeah, so the difference, right? You have your marginal rate, you have your effective tax rate. So our tax system is progressive in the sense that each bracket, so the dollar amount that falls in each bracket, whatever that tax percentage is for that bracket is the amount you pay for that dollar amount. So, man, I off the top of my head, numbers wise, first bracket's 10%, second bracket is 12%. So the first dollar amounts in that bracket, from zero all the way up, I think married filing jointly, I think it's like about $22,000. It's taxed at 10%. And then from 22,000 married filing jointly up to like 90,000 is taxed at 12%. So your first $90,000 that you make filing jointly is taxed at 12% for the most part, and a small percent is taxed at 10%. So your first $90,000, even if you're making $400,000 and you're in a 32% tax bracket, first $90,000 isn't taxed at 32%. It's taxed at roughly anywhere from 12 to 10%. So when you average out the total dollar amounts that you make along with the percentages in each tax bracket, that average percentage is your effective tax rate. Even though you might be in this tax bracket, you're making $400,000 a year, you might be in the 32% tax bracket. Majority of your money is not. I mean, at that dollar amount, actually, I think 95% of your money is taxed from 0 to 22%. And then it jumps up to 32% based on rates right now. So that dollar amount and when it comes to effective tax rate, very different than what the marginal rate is.
Okay, so y'all thrown around terms like AGI and taxable income, and now we're talking about rates. What's that rate based on? Is it taxable income or is it AGI?
Which rate? You're
Marginal rate. I'll answer my own question.
Yeah, go ahead.
It's based on taxable income.
Yeah.
And taxable income happens to be after standard or itemized deductions from AGI.
So So above the line deductions to get your AGI, below the line deductions, which are your itemized standard deductions, along with some other deductions, total income, and then your effective tax rate is based off of that total income.
Yeah.
One thing that comes up once in a while, and even I have to double check on it and then refer to you sometimes, is
sometimes. Very few times.
Is, oh gosh, and now I lost it trying to be funny. Good for you.
Yeah. This is not a funny podcast.
No, it's not. This is such a serious podcast. Credits that are refundable and non-refundable.
Yeah.
You just thought you'd slip it in here, huh?
You
Sure.
just throw it in there.
Well, we were talking about a couple of different things that come up from a foundational perspective.
What you brought it, sir.
Unpack it.
What?
I said sometimes I get
some credits are non-refundable, some are refundable.
Meaning?
Unpacked.
What does that mean?
Some you will actually get like if let's say it's a $2,000 refundable credit and you only owe $1,000 of taxes. The first $1,000 of that refundable credit will wipe out that $1,000 taxes, and you'll even get $1,000 back in your pocket
On top of it.
Not refundable is if the credit's in excess of the amount of tax owed, sorry, you're out of luck.
Right. Yeah.
Glad we decided to slip that in there with the taxable income part of it.
Yeah.
Going back to the taxable income part of it. Well, I guess it's kind of
It's related.
whatever. You know what? I think and this is kind of foundational.
Yes.
I think what's super important is the estimated tax penalty. Because a client actually let me know the other day that the penalty has gone up. Did you know it's based on interest rates?
Actually, I did. I don't know how it's based on interest rates, but I do know it's relative to the way it's determined.
Wow. Yeah.
So I always believe clients.
Is it Fed fund rate?
I don't know what it is. Is it prime plus 3? Ooh,
Sounds
I might have
right.
just missed.
Whoa,
Yeah.
whoa.
Don't fact check me. It's the highest it's been in umpteen years.
Oh wow.
So yeah. So what is that? What is an estimated tax penalty? What are estimated taxes?
Yeah, every year, especially when you're working with a tax professional, they'll calculate how much they think you need to payments you need to make towards your taxes, and if you don't during taxes, there's a penalty which you have to pay in addition to your tax liability. So it's key that you stay on top of it and actually follow those estimated tax payments calculations that they're doing for you. I didn't realize they actually go up with interest rate. That's crazy.
Yeah.
So.
Yeah. I mean, I thought it was crazy when I heard it.
Yeah.
I mean, I believe everybody is. Since I may have done a Google search.
Quick
afterwards.
Google.
Did you really?
Google.
Wow. Yeah.
But it makes sense.
Oh, total sense.
Yeah.
Yeah.
Well, and I think it's interesting because what I was hearing a lot when money market rates started going up is like, hey, the estimated tax penalty is lower than the money market rate. By the way, not advocating for this, not recommending this, not
I
condoning
know where this is going.
but there's plenty of people that decided to just leave their money in the money market
Right.
because they were getting more interest than the penalty. And now, I mean,
Not so much.
Not so much.
I
So
may hear things like comments like, I don't want them to get their money until I have to.
I may have heard comments like, "I'm not going to loan the government any money."
That's more direct.
They thought that was fun. They said, "Not so fast, not so fast."
That they always find a way.
No
Yeah.
kidding.
Okay. Well, but should everybody be making estimated tax payments? In other words, do wage earners, who pays estimated taxes? How about that?
Oh, I see. Well, if you're a wage earner, your employer is withholding for you. But if self-employed individuals, you're having to make estimated tax payments. Yeah, yeah.
And even some retirees that their income's high enough, right?
Yeah,
Right.
yeah. Depending on what their total taxable income is.
Yeah.
In retirement.
Yeah. So pay your estimated taxes, right?
Pay 'em quarterly.
That's a good way to reduce your tax burden.
Yeah, it's a silly. It's an unnecessary expense completely. And obviously having someone that can help you, determine what that looks like, right? So working with a professional that can help you determine and get an appropriate dollar amount as well too. Because there's some individuals that you try and calculate that and you're miscalculating it completely. So then you're also overpaying in those estimated tax wages, which is not good either. You don't want to do that either, right? So you want to try to get that as efficient as possible. And then also having someone there for accountability as well too isn't a bad idea.
Yeah. Okay. Let's talk about other things above the line. We talked about deductions. What about income?
Mm-hmm.
So there's different, when you look at a tax return, there's things above the line. There's things like tax exempt interest, Social Security benefits, wages,
Interest,
capital
capital gains,
and dividends.
Yep.
Yeah.
So are all those sources of income treated the same? Like, are they all taxed at the same rate?
No. For example, interest and dividends are taxed as ordinary income, and capital gains, if you sold an investment for at least a year or more, those are taxed at capital gains taxes, which is lower usually for most people.
Yeah. And interest and ordinary dividends are taxed at regular rates, but qualified dividends are taxed at capital gains rate. Yeah.
Yep.
And what are some of those capital gains rates?
15% and 20%.
Come on, man. Did you forget the most important one?
The zero?
The zero.
The goose egg?
Yeah.
Yeah.
Is it good to pay 0%?
Depending on what your income is, you may not have to pay capital gains taxes.
Say more.
Say less.
No, say more. What do you mean, depending on what your income is?
I don't know. I would have to look it up, but yeah, if your total adjusted or if your total income is below a certain level, then your capital gains tax liability is zero. What is it like? 20?
I believe in 2025 that if your taxable income is, I think it's like $100,000. It's definitely around anywhere from 90 to 100. You'll have to look it up, but if your taxable income is that amount, you pay 0% on capital gains and qualified dividends.
Is that good?
Well,
Zero
here-
is always. I don't know. It could. Yeah. It could.
always.
No, it's not. It's not
We,
always.
we
It
don't.
could
We don't
be.
like to talk in absolutes. Never.
Never.
Yeah.
We never do.
But anyway, the thing I like to point out to people is that's taxable income.
Right.
So that's after your standard and itemized deductions.
Right.
So that means what's standard deduction right now? 2025? Is it?
It's 30,000
Right.
for joint, for filing joint, and 15 for single.
Right.
Yeah.
Yeah.
So you're talking about maybe like $130,000 of adjusted gross income.
Yeah, it's a big number.
Yeah.
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 I think it's also worth noting that it's first your ordinary income, and then whatever's left in the bracket is what determines whatever capital gains are left in the bracket determines the rate on the capital gains. Do you know what I mean? So let me give you. Let me give you a better example. Let's say you have exactly $100,000 of income, $50,000 in pension benefit, and $50,000 in capital gains. The $50,000 would be taxed at your ordinary income rate.
Mm-hmm.
If the first $100,000 of taxable income is of capital gains is taxed at zero, the remaining $50,000 of capital gains will be taxed at 0%. Did that help or no?
That
No,
sounds
I'm
amazing.
just kidding. Yes, I got it.
If it's 150,
Hopefully they got it.
Yeah, hopefully they got it. Well, they can rewind and pause and
Slow.
Google.
You listen. I listen to things at 1.25 speed. Podcast. This one they'll have to do 0.5 speed.
The other way.
half like slow mo half.
Or they can make their own Venn diagram and flow chart and everything. Or they can just call us.
Just call.
We have our charts in the office, so
Shameless plug.
we'll actually remember.
Yeah.
Yeah.
Well, I think that's important because that's actually come up quite a bit recently. Yeah. Anyway. What else, guys?
Different types of tax forms.
Oh yeah. Oh, that's a good one.
Right.
Okay, so
What are they? Yeah.
Yeah,
The most common one. Yeah.
Excuse me.
Oh,
Well, you got. Oh yeah, we've been talking about it the whole time. But the 1040, right?
Yeah. Yep. Yeah. So I mean, everyone files a 1040. That's the main tax filing form. But small businesses, they have a specific form that they have to file for their business as well too, and depending on the type of business, there's different forms for so many different things. So you get, if you're a W-2 wage earner, you're going to get a specific form as a W-2 wage earner. If you're a contract or self-employed, you get a different form that you file with your taxes for that as 1099. There's a form that you utilize for Roth conversions. There's forms that you utilize. I mean, there's different forms for all different things, but understanding that depending on what source of income you have, where those sources of income are coming from, and also specific deductions you've done over the year, you want to have an idea that there are different forms for all those different things.
yeah. Yep. Thank you. I was thinking more like, okay, if I'm a business owner, let's say I have an LLC, like you said, 1099 or whatever, or Schedule C. Where does that income? How does that income interact or play into my 1040?
Like, where is it? Like when you're
Does it
filing
even come out in 1040?
Yeah, if you have an S corp, the S corp flows directly into your 1040. So that whatever that dollar amount is from your S corp flows in as income. That income is reported directly to your 1040. So that'll show immediately right on there.
Just S corps?
No, partnership, that'll show on there.
So any flow through business.
Any flow through business. Yep.
Or if you're just self-employed too, it's passed through.
Yep. Anything that passes through will go directly from the business straight to your 1040.
And you got your basic things like your Schedule A if you itemize.
Right.
I think Schedule D is for capital. Is that for capital gains? And I think Schedule B for interest and dividends, which are all in your 1040. But it's in those schedules where they're aggregated. So.
Yeah. Okay. Y'all haven't. Tell me more about itemized versus standard deduction.
Oh, yeah.
What is
Why
that?
did we know you're going to go there? Why did we know?
I mean, because it's what they want to know.
The government loves us, so everyone gets a standard deduction. So below your AGI, you can reduce it by the standard deduction for 2025. For married filing joint, it's $30,000. For 2024, I think it was like $29,600 or something like that. But you can also itemize, meaning if you have enough deductions that it's more than the standard that the government gives you, you can actually use the itemized deduction, and that goes on your Schedule A. So things like property taxes, mortgage interest, if you add all of those up and it's more than the standard deduction, you can go ahead and take the itemized deduction. So
Well, that's nice of them.
it's very nice.
Yeah.
Yeah.
Cumbersome. It can be.
Sure. Sure. Hey, guy. I want you to.
Hey, pal.
I want you to talk more about your favorite. I feel like this is your
Oh
favorite.
gosh.
Yes. Yeah. Come on. Can you talk? I think this is foundational enough. Or let me back up.
If you're
Common
if you're
miscon-
thinking whether or not it's foundational or not, it is probably not. But okay, go ahead.
No, I'm not. No, I'm no. I'm trying to put myself in your shoes. I think it's very foundational, unequivocally, unwavering. Okay. I might be wrong.
Here we go.
I hear one common misconception I hear a lot is people will say stuff like, "Hey, I want to open this business up so I can lower my taxes, or I want to get this property so I can lower my taxes."
Oh, that is perfect for him.
Right, and that's foundational
Yes.
enough, right? Yeah, that's
He
perfect.
loves these kind of questions.
Why is that wrong? Why is that a misconception?
Um, well, you have to understand that there are ancillary effects to lowering your taxable income, especially when you're taking expenses like that as well too. So for a business, if you're utilizing more expenses to try to lower down the tax liability for the cost, what's going to show is that business is not producing revenue. It's not making anything. And so in some circumstances, especially for individuals that are trying to borrow or lend, one of the things that they look at are these entities, especially S corps, or actually really anything that flows through, right? So all those businesses are going to flow through directly onto your 1040. And so those losses can reduce your taxable income, and your taxable income is what they utilize to determine debt to income. So you have to have a certain debt to income ratio to be able to borrow and lend with most institutions. And so by doing that, there can be a direct effect on your eligibility to be able to do some of those things. So you have to determine like, hey, like, okay, I'm doing this startup. I'm trying to do all this. What do I want to expense? What do I really not want to expense? What are the benefits? And then are there any effects that it could have on other things that I may need to do that are going to reflect based upon what my total income is going to be?
Yeah, and just that basic concept of I'm going to start a business
And take losses.
I hope it sucks.
Yeah.
And then
Hope I lose money.
I hope I lose money so I can get a bit bigger deduction, even though I'm already getting a refund.
Right.
It's just so weird. And there are some unique things like hobby rules too that come into play. So yeah.
Well, that's where I was hoping we were going with this.
Oh, really?
Hobby loss rules and passive activity losses. But everything y'all said is true. But since you mentioned hobby
no.
can you just what is hobby loss rules? You don't have to get like the actual.
Well, if the IRS determines that you actually don't have a real business and it's determines more of a hobby, you won't be able to deduct those expenses that you were hoping you were going to use to get a deduction. So.
Thank you,
Yeah.
sir. Passive activity loss.
Yeah, so some income is identified as passive income. There's a formality and way to determine specifically how it's passive or not, but pretty much if you're not working in that business regularly and you're not putting in actually time and effort to be able to produce that income, rental income is a big one that we see. It's passive. That income is different than active income. So if you have passive losses, so if you have rental income, you set up a rental a rental home and you expense it all the way down, and that property, even with your rental income, lost money. You cannot take the losses from that passive entity from the business that you have passive income coming from. You can't take those losses and offset your active working income. Two different things. Passive losses, you can offset passive gains. Active losses, you can offset active gains. So there's a difference in the way that they look at how you made that income, and whether the losses can offset gains depending on the way that you earned it.
And since this is a tax tutorial, you mentioned I want to make sure people understand this because I think this is a misconception. I've over the years I've heard people say like, "Hey, I didn't know any taxes this year," and I'll look at a tax return and I'll see like $100,000 taxes, and I'm like, what do you mean?
Yeah.
When people say that, they usually mean like I didn't have to write a check.
Yep.
Or I didn't have to go to EFTPS to make quarterlies. Doesn't mean that they didn't pay taxes that year. So you might not have physically written a check, but you can still reduce your tax burden.
Right. Yeah.
Would y'all agree?
Oh, yeah, agree. One of the other things that comes up with specifically W-2 employees that I work with, or just clients in general that we've spoken to, is this common misconception that getting a tax refund is a good thing.
Yeah.
Right?
Yeah.
And I tried to explain to them.
And that's my trip money, man.
I tried to explain to him that it's not necessarily a good thing, right? It really isn't. Because what you're doing is your employer is withholding taxes from your working income and sending that to the government. And at the end of the year, when you go file, what happens is that you file, you put in all your deductions, you determine what your taxable income is, you look at how much you paid in taxes, and they realize, oh, you paid a little bit too much this year. Here's your money back. Well, all that extra money that you received at the end of the year as a refund was money that you could have had during the year and utilized opportunity costs, right? You could have utilized it way more effectively. Instead of buying that PS5 a year later, you could have got it, a year before, right? It doesn't, whatever, but it is, people don't realize that's your money you're getting back. It's not like the government is giving you extra money that you didn't earn. It's your money that you paid them. It was more than what you should have paid them. And so I think that people have to understand that the closer you can get to zero at the end of the day, as far as what you would have to pay additional to what you've paid throughout the year, is way more efficient.
Okay, sir. We'll help our viewers out. How do I do that?
Yeah. Mr. PS5.
Give us a call at 956.
Go to your employer and fill out a W-4. It's W-4, right?
Oh, yeah.
Yeah, W4. But yeah,
Re-look at your W-4. Well,
adjust.
consult your tax advisor, and then you might need to amend your W-4 with your employer.
well, consult a tax advisor, because there are, and I've had this come up, where there have been individuals in HR making recommendations as far as how they should be filling out their W-4.
Yeah.
Do not, that is,
The employer will not tell you.
they should not. They should not. Okay. And they won't. So consult tax professional will be able to help you make that decision.
Okay, and Mr. Word of the Day, ancillary. There's some ancillary things. Okay, so I'm going to do that. Oops, I was wrong. I owe a little bit more taxes. Mr. Chang, I don't have that money.
Yeah.
What do I do?
I mean, you're screwed.
Family and friends?
I mean, you can make payments, right? So you can work with IRS to schedule a payment system to be able to make those payments and be whole.
Yeah. Don't if you get a refund, don't just automatically, depending on your discipline, right?
Yeah.
Like,
and who's keeping you accountable?
Yeah.
Right. Like if you don't have the discipline to set money aside for your tax payment later, you know what? So what? You loan the government some money and you get a refund. That's probably better than being in the hole with the government.
To thine own self be true. Sorry.
Wow. Okay. And on that note, yeah.
I think that was everyone probably feels so much more prepared and smarter about taxes now after that conversation. But those are good. I mean, I think those are good foundational tips.
Yeah. I guess I would leave everyone with the fact that just because we're financial advisors doesn't mean we just do investments.
Right.
There's a reason why we're talking about this. What is that reason?
Is it because we like taxes?
There's that, but why else? Why aren't you staying in your lane?
Ooh, you're gonna put me in that.
That's right.
Oh my goodness.
And we talked about it before, and I don't know why I had
Bring
to
the
remind
boom
you
mic, guys. Let's bring in the boom mic.
Oh my goodness. Well, over the years when working with clients, a common statement that we would get is sometimes they feel like their tax professional is not helping them with proactive tax planning. They're just helping them with their tax returns. And that was kind of an aha moment for us where there's an opportunity here to enhance our services for our clients. And as you mentioned earlier in the beginning, I mean, tax planning is such a big component of what we do because the recommendations we make have a tax impact. So you can't just ignore it. Whether it's helping the clients save money on their taxes, getting tax efficient returns, everything has an impact. And so to us, it's very important to do tax planning with our clients because when you're offering holistic financial planning, it's a pivotal part of what we do. So, yeah.
Hear, hear.
Amen,
Yeah.
brother.
Yes,
Yeah.
amen.
Yeah.
Preach. And with that being said, thank you again for tuning into another episode of Our 2 Cents on Your Dollars.